35% is where it starts the next morning and finishes even lower. Okay? Am I likely to lose 10% or am I more likely to lose 35 or more percent?
You're more likely to lose a lot more, 30, 35%, somewhere in that range.
Right. Okay. That's the problem. One of the problems with stop orders. Another problem with stop orders is that if you place that order too tight, well, golly, your stock could be going up. But if you place your stop order too tight, I don't know about you, Mike, but I've actually learned how to predict the future. Would you like to know how?
Yeah, I'd like to know how to predict your future.
Here's the deal, okay? I used to predict the future when I had stop orders in place. I predicted the lowest price my stock would trade for at that day.
Mm-hmm.
And the way that I did that was by setting a stop order. And guess what? That's exactly the lowest that stock would trade that day. I get stopped out, and then the stock would go up. It was infuriating. And I don't know if anybody out there that's using stop orders have experienced either one of these problems, the gap problem or getting stopped out when you shouldn't.
Well, I talked to several customers on Monday who got stopped out of their positions because they tracked their stop orders up, following that little bear market rally or whatever that was the last 2 weeks. And then lo and behold, something happens over the weekend. They've adjusted their stops up to higher prices, and then they were just closed out of them right away because of the gap down Monday morning.
Right. No fun.
No
okay.
fun.
Well, what about diversification? That's not the answer either, okay? I believe that diversifying a little bit is important, okay? But if all we're doing is trying to spread out among many instruments, okay? Well, the theory is, well, geez, I'm so good at picking stocks that if one or two of them are down, that's okay because the others will be up. But there's a problem with that. What about a large-scale downturn? What if the whole market is down? Okay, then you have 35 bad positions to manage instead of just a handful.
Mm-hmm.
And I think the approach lacks focus. I mean, after all, the reason that I invest is for financial freedom. And the reason for financial freedom is to have more time to do the things I want to do.
That's right.
And if I'm constantly glued to the TV screen, when do I have a chance to play with my kids? When do you have a chance to play with your grandkids?
Mm-hmm.
And the approach lacks focus if all we're doing is diversifying. Okay, so what's the answer? The martingale is the mathematical factor that takes your account and ratchets it down little by little or eats into your gains to where they're unsatisfying. Okay? He feeds best in an emotionally charged environment. If you don't have a disciplined loss protection plan, remember the folks that answered hold till it hurts?
Right.
Or hold till the bitter end?
Mm-hmm.
Or money management, what's that? Okay, I'll bet that those folks were not in the 9% that said yes, they were happy with their trading results from last year. Okay, but what I will say is probably those folks that are using stop loss orders and diversification, that probably they found that that's not a total solution either. Okay, so what is? Well, this is my solution. This is what I use, and I've been using for 7 years now, and have been teaching. A put option contract guarantees your stock's exit price up until expiration.
Mm-hmm.
Now, if you have a stop-loss order in place, okay, and your stock dips down for some reason or another, just gets hit with bad news, you're out, okay? On the other hand, you can read that bad news and say, hey, I'll give you an example. I had shares of Energizer, and Energizer is the leading battery maker in the world. They're the best, okay? I had shares of Energizer, and I had bought a stock. Bought the stock. I had also bought a put and sold a call against. And the very next day, the stock takes a tumble. It takes like a 7-point dip. And they blamed it on the price of zinc being high.
Sure.
Yeah, and I thought, well, okay, that's fine. Here's the deal. People are still going to buy batteries, right?
Absolutely.
They're going to still buy batteries. And the price of zinc affects all battery makers. So everyone's going to raise their prices. And everybody's going to return to, earnings levels that make sense for their company, okay? But Energizer is going to be at the top of the heap because they are the best. Well, can you make all that reasoning? Can you think through all that through if all you've got in place is a stop loss?
You don't have the time.
Yeah, exactly. It gets executed without, even consulting you, okay? On the other hand, having a put option in place, I can bide my time. I can wait out a correction. I wrote all my Fission members. I said, hey, here's a chance for me to show because I just closed my shorts and I held my married put position and Energizer climbed right back up within another few days. Okay, it was amazing, and I had a lot of folks write in saying, because they gotten into the same position. Okay?
That's right. Yeah.
If you've got a put option, you've got control, and that's what I'm looking to give folks, control, so that you can get out at the exact price that you bargained for in the beginning. On the other hand, if you decide that you want to play it for further gains, well, you have that option. You have that choice. Okay. My mission is to give more private investors control. The institutions do it. For example, any mutual fund prospectus that I've ever seen has informed me that the fund manager may at times enter into married put positions or collars, which is a married put position with a call sold against. Okay, now we do a lot more sophisticated stuff than that. We actually have the luxury of being able to maneuver a lot more quickly and do this same strategy a lot more efficiently and better. Okay, but if these folks that are stewarding millions, sometimes billions of dollars of the public's money, if they do it as a matter of course, shouldn't you know how? Shouldn't we know about the married put? Well, I think so. Okay. The married put position is the only configuration that I'm aware of, okay, that can take a stock that you already own, perhaps that you get as compensation from work, or perhaps as that you are playing in your IRA, okay, and make it so that it has a floor and yet an unlimited upside. Okay, it has unlimited upside potential. It has a definite floor to where you can't get hurt. Okay,
that's right.
We've had some folks send in the argument, okay, long calls are the same. You know what long calls are? Long calls are leverage. Remember that fellow earlier that lost 87% of his investment?
That's right. Yeah.
He was in long calls. Sure, he was. Okay, we're going to do this, and doing it the married put way is going to figure out our position sizing for us. All right, so to recap what we've done here so far, right away we're going to get into the next income methods, okay? But to recap what we've done so far, the holy grail of trading, as far as I'm concerned, is risk management. Knowing how much trouble you can get in the first place and controlling that, okay? That's the holy grail of trading. Rather than picking stocks, I like to say pick stops. And I don't mean the stop loss order, I mean an absolute price at which you can get out. Okay, but what makes radioactive trading unique is what we call bulletproofing, the income methods. And my catchy saying for that is, rather than timing trades, trade time. Now we're going to ask another poll here, because we want to know, Mike and I want to know how to pace this next portion. Okay, we want to know about your experience in options trading and what you do now. Perhaps you don't do options at all. Perhaps you've been exposed to covered calls, and maybe you're a spread trader, kind of sophisticated, you know some good stuff. We're gonna shed some new light on all of those strategies that I have up there. Wow. Mike, the results are still coming in, but out of the respondents so far, 67% are doing covered calls.
Okay.
Nobody so far has said options me no likey.
There you go.
Oh, that just changed.
It was me. No.
Yeah. I had one person say that they do covered calls and options me no likey. So I understand about that. Okay. Let's see. We've got nearly all of our votes in. I'm going to go ahead and close it off here in another 5 seconds. That'll be a whole minute that we've had that poll up. Okay. All right. The poll's been up a minute. Let me close it and share the results. Okay. Can you see that, Mike?
Yes, sir.
Okay, 3% say options me no likey. Okay, so I'm going to tell the folks that are listening, perhaps you don't know enough about options yet, but I'll go ahead and be the one to tell you. Options trading can be really risky if you don't know what the position represents. Okay, but I'm going to endeavor to make the positions really simple to understand, and that is that rather than buying a whole bunch of calls or puts with the hope that they're going to go up, or rather than selling calls and puts with the hopes that they are not going to be exercised, that they're going to expire worthless, rather than that, we're going to learn about how to use options as a insurance policy, okay? And then how to use options as an adjustment. So it's not all about leveraging yourselves beyond belief, okay? It's all about just using options to stay out of trouble. After all, maybe the reason you said options me no like is because you can get in trouble, Okay, we're going to learn how to stay out of trouble. Okay, now here's an interesting fact. 63% said that they trade covered calls, but only 25% would trade a naked